Hi there, in this video, we'll explain how capital gains tax may arise when an inherited property sells above its probate value.
Picture this. You've just gone through the incredibly difficult, heartbreaking process of losing a parent. You've somehow managed to navigate the heavy bureaucracy of the probate system, spent weekends clearing out your childhood home, and finally you put Mum's house on the market. It eventually sells for a staggering £410,000. But right as you're about to breathe a sigh of relief and, just move forward, a terrifying thought strikes you. You suddenly remember that the house was originally bought for just £10,000 way back in 1974, and you think, wait, am I about to be handed a catastrophic capital gains tax bill by HM Revenue and Customs on a £400,000 profit? Well, let me tell you, it's a highly stressful scenario that UK families completely overlook all the time, and it causes countless sleepless nights for folks acting as executors or beneficiaries.
So, this right here, it's the absolute most common, and frankly, the most panic-inducing question I hear from clients dealing with estate administration. They look at that £410,000 sale price, they look at what their parents originally paid decades ago, and they do some quick, terrifying mental math. Naturally, they assume they owe tens of thousands of pounds in tax, which threatens to just wipe out a massive chunk of their family inheritance. So let's address the elephant in the room right now. Do you actually owe capital gains tax on that entire amount?
Okay, you can go ahead and breathe a massive sigh of relief right now. The answer is no. You only pay tax on the gain strictly above the probate value. I have literally seen clients physically slump in their chairs with relief upon hearing this. It's a real game changer. Let's unpack this together and see how this one single rule changes absolutely everything about how you handle an inherited property here in the UK. Because honestly, understanding this is the absolute key to protecting your family's assets.
Hello and a very warm welcome. I am your host and lead tax expert here at My Tax Accountant, or MTA for short. We are a UK accounting firm dedicated to helping individuals exactly like you navigate the complex and, let's face it, often overwhelming world of tax compliance. Today in this explainer, I am going to guide you step by step through the process of selling Mum's house after probate. We're going to look precisely at how the capital gains tax gain above probate value actually works, so by the end of this, you can walk away feeling confident and fully in control.
Here is our quick roadmap for today's explainer. First, we'll cover the probate value rule. Then, calculating your taxable gain. Next, deductions you can claim. After that, tax rates and allowances. Then, my favorite, the deeds of appropriation strategy. And finally, next steps with MTA.
All right, let's dive into Section 1, the probate value rule, also known as the date of death uplift. Under UK tax law, specifically Section 62(1) of the Taxation of Chargeable Gains Act 1992, if you want to get technical, the base cost of the deceased's assets automatically resets. This is a vital protection for you. Basically, you're treated as acquiring the property at its fair open market value at the exact date of death. Notice I said date of death, not the date the grant of probate was finally issued, which, could easily be several months later, and certainly not the original purchase price from decades ago. So if Mum bought the house for £10,000, but it was worth £380,000 on the day she passed away, your starting point for capital gains tax is £380,000. Now, there is a genuine tension here that we often discover when reviewing estates. People sometimes try to pitch the probate value artificially low, thinking they're cleverly saving on inheritance tax. But actually, scratch that, it's a massive compliance risk and a complete false economy. Why? Because it simply creates a much larger, heavily taxed capital gains bill when you go to sell the property later. You absolutely must use an accurate professional open market valuation at the date of death.
Moving right along to Section 2, calculating your taxable gain, using our £410,000 scenario.
Let's break down the step-by-step formula so you can see exactly how the math works in the real world. Step 1, we take the sale proceeds. Let's use the £410,000 you actually received from the buyer upon completion. Step 2, we subtract the probate value. If the RCIS valuation certificate at the date of death confirmed the property was worth £380,000, well, we subtract that entire amount, so your gross gain is now just £30,000. But hang on, we aren't done yet. Step 3, less deductions. You get to subtract allowable selling costs and improvement expenses, which we're going to cover in detail in just a moment. Let's assume for this scenario, those add up to £7,000. That brings your gain down to £23,000. Finally, step 4, less the annual exempt amount. For the 2026-27 tax year, this allowance is £3,000. So your final taxable gain would be £20,000. That means you are only taxed on that £20,000 sliver of profit, not the terrifying $410,000 sale price. How much better does that sound?
Let's look at Section 3,
deductions you can claim to maximize your relief.
Okay, here is a professional tip for you. HMRC draws a very strict, completely uncompromising line between capital expenses and revenue expenses. Knowing the difference is literally how you legally maximize your tax relief. Allowable capital expenses include the upfront costs of establishing title, your solicitor's conveyancing fees, the estate agent commissions for selling the property, and capital improvements that add lasting structural value to the home, like building a brand new extension or totally installing a new kitchen before the sale. On the flip side, you absolutely cannot deduct non-allowable revenue expenses from a capital gain. These are your day-to-day running costs. Things like routine maintenance, replacing a like-for-like broken window, redecorating the living room, paying the council tax, covering utility bills, or paying mortgage interest while the house sits empty waiting for a buyer. Mixing these categories up is an incredibly common mistake, and let me tell you, it is a surefire way to trigger an unexpected HMRC inquiry.
Section 4. Tax rates and allowances. What are the rules for 2026/27?
This number is absolutely vital to keep in mind. £3,000. That is your annual exempt amount, basically your tax-free allowance for the 2026/27 tax year. The government has currently frozen it at this level until 2031. Now, if the property is being sold by the estate itself, meaning by the executors or personal representatives before it's passed to the beneficiaries, the estate is entitled to this full £3,000 allowance. However, this is strictly restricted to the tax year of death and the 2 following tax years. After that specific 3-year window closes, the estate gets absolutely zero allowance. It'll be taxed from the very first pound of profit. So, let's look at how these specific tax brackets apply to your remaining gain. If you, as an individual beneficiary, sell the inherited house, the tax rate depends entirely on your personal income for that year. If your total taxable income, when added to this capital gain, keeps you within the basic rate band, you pay 18% on the residential property gain. If the gain pushes you into the higher or additional rate band, well, you pay 24%. But here is a dangerous trap that catches a surprising number of executors out. Honestly, even experienced solicitors sometimes miss this detail. If the personal representatives sell the property directly during the administration period on behalf of the estate itself does not get a basic rate band at all. None. It is forced to pay a flat 24% on all residential property gains above the allowance.
Now, before we talk strategy, here is an essential insight for you. Did you know you must report and actually pay your capital gains tax to HMRC within 60 days of the completion of the sale? Keep in mind, this is not 60 days from the exchange of contracts, but the final completion date. This entire process is done online through the UK Property Reporting Service. Late filing triggers automatic, immediate financial penalties. And here's the real kicker. Those penalties apply regardless of whether any tax is actually due. Do not get caught out by this 60-day ticking clock.
All right, Section 5. This is the good stuff. Deeds of appropriation strategy, the secret to lower taxes.
Let's unpack a strategy that can completely bypass that flat 24% estate tax rate we just talked about. A deed of appropriation is a simple but incredibly powerful legal document. It allows the personal representatives to formally allocate the property to the beneficiaries, essentially holding it on what's called a bare trust for them before the property is actually sold to a buyer. Now, you might be wondering, why would you go out of your way to do this? Well, instead of the estate selling the property, getting just one single £3,000 allowance and paying a flat 24% tax, the beneficiaries are now legally treated as selling it. So if there are 3 siblings inheriting the house, they each get to use their own individual £3,000 allowance. That instantly equates to £9,000 completely tax-free. Furthermore, if any of those siblings happen to be basic rate taxpayers, they'll only pay 18% on their specific share of the gain, completely avoiding the estate's mandatory 24% rate. This single, simple piece of paper can literally save UK families thousands of pounds.
But listen to me, timing is absolutely everything when it comes to this tax strategy. Let's trace the exact timeline you must follow to make this work legally. First, step 1, you get the official probate value set at the date of death. Step 2, you put the house on the market and an offer is accepted by a buyer. Now, here is the critical moment. Step 3, you must sign and date the deed of appropriation before you reach step 4, which is the exchange of contracts. If you exchange contracts even 1 hour before signing the deed, it is entirely too late. The sale permanently belongs to the estate. Finally, step 5, after completion, you then have your strict 60-day deadline for each individual beneficiary to report their respective share to HMRC.
And that brings us to Section 6, Next Steps with MTA. Let's secure your peace of mind.
You know, the overarching rule in UK tax is actually quite simple. You should never pay a single penny more in tax than you are legally required to. But getting it right, that requires absolute precision, accurate valuations, and timely legal documentation. You certainly do not have to navigate this stressful, high-stakes process alone. Reach out to us at My Tax Accountant for professional, friendly assistance. You can call us directly on 0208-570-8531, drop us an email at info@mytaxaccountant.co.uk, or visit our website at www.mytaxaccountant.co.uk. We are here to help you secure your peace of mind and protect your family's hard-earned assets. Also, please don't forget to subscribe to the MTA YouTube channel for more clear, actionable tax explainers just like this one. Finally, a quick mandatory note. This explainer is for educational purposes and does not constitute formal financial or legal advice. Tax laws are complex and depend entirely on your individual circumstances, so please always consult a professional. Thank you so much for joining me today. So what step will you take first to protect your inheritance? Reach out and let's get your tax affairs perfectly in order.